Hopefully, your stomach's recovered after turkey's Christmas stuffing, mashed potatoes in US, or carbs and herrings in most of European countries. And your minds may finally be occupied by something else than digesting heavy Christmas dishes. Majority of stocks recently on Friday and yesterday made small advances. Currencies were mainly mixed throughout recent time, and we were led by cautious trading and reduced liquidity, with many markets closed for holidays. So I guess you haven't probably missed much. Sometimes it's better to skip some days to avoid some pesky traps that may be caused by low liquidity. And today, one of the topics that I will bring will be just how to avoid such market manipulations that were quite often during recent sessions due to lower liquidity span on the market. So I'm very glad you're here. It's Blockrevision. It's 8:45 a.m. East time. So why not to start another dose of market news? So let's begin. All right, and we are, as always, with economy view. But let me first find out whether we are live for this one. Maybe you may tell me in the chat just live right now to reassure me that everything works fine. So I will make it. I make it myself anyway. So let me find out. I need to switch windows. So what I can find. Yes, we are officially live. All right. Let me find out everything that works again. All right. So let's start with yearly rebalancing. So we've gone through a quite tough time this year, especially the last period of a year is the time where rebalancing takes place, where many funds, in order to achieve a mix of 60% of stocks and 40% of bonds, need to reallocate some assets in that manner that may increase bonds as it has devalued, as we do know, this year heavily. That's why the stocks haven't had a good end of a year. Santa Claus rally has been cancelled, as I told in the recent episode. If you haven't watched it, you might do it right now, as there are many interesting topics out there. And so we have this pensions, sovereign wealth funds that form the backbone of the investing community, typically rebalancing their market exposures every quarter. And that's why right now we are going through a quite tough moment on the market. The recent equity market correction and bond rally is consistent with the hypothesis I've just brought to you. That's why we are right now suffering from kind of a choppy and sideways movements on the market with this downward pressure. Recent equity market correction and bond rally brought more bears that I would really suppose. So as we are right now in a time span where the market is dominated by bears, turning up even more of them is not an usual phenomenon. But I will tell about this again a bit later. So right now we are in the environment where investors had to sell stocks and buy bonds to get back to this 60-40 target, and it may probably continue until the end of the year. That's why don't get surprised by underperformance by the end of this week. What we have also to consider is this sector rotation. So by the end of the year, many hedge funds, many pension funds are trying to reassess their portfolios. So when they got profitable on different particular type of sector, market sector, they will try to minimize this exposure going to the next year. That's why many of them outperformance, many of the front runners may start lagging in relation to other sectors when this rebalancing eventually take place. And fourth quarter, the end of the fourth quarter, is absolutely the one that the one of the periods that have this kind of market shift might take place. In sector rotation graph that I'm just have showcasing you as this where you can find the economy also always is a lagging towards market. So market is tend to front run the economy by 6 to 12 months. Usually it's 6 to 9, and that's why where we are assessing have been in early recession. Supposedly, we do find that also many funds will turn to more like healthcare, utilities, and finance stocks rather than of that. That's why also energy sector recently has got much more painful results. So I have a concealing fact for you. So after healthcare, utilities, finance have its 5 minutes, I will get back to US 100 and Nasdaq that has had a enormous performance during this 1.5 year after pandemic broken out. That's why I would turn to Nasdaq 100 for a long term, supposedly sometime during next year. What time will it be? I will tell you when I just find the type of rebound. That's if you don't want to miss that moment, you may subscribe to the channel right now. And heading towards next element is the market outlook. For the moment, I will jump to a charts, and inside of it, DXY still is moving in a side of this channel that right now is showing due to lower liquidity, not many signs of particular pivot. So when this liquidity start to turn up, I would expect another lows to get built, and possibly this will be another fine moment for the markets to perform in a bit better way than previously. So DXY was underperforming. SPX right now is trying to take advantage of a weak dollar, but with this recent slump, we don't also finding anything, especially that may bode well for this US index. About the trade idea and what I find as a next kind of an opportunity on the market, wait till the end. So right now, heading back to market outlook, and do we have signs of rebound. So right here you have QQQ's short interest as a proportion of shares outstanding hovers at a decade high, and recently such a high level been noted on 2012. So I would say that investors don't appear to be signaling confidence that patterns that pattern emerges again, where this kind of a shorts are right now the dominant power on the market. So recently we've been still trading above closing low for the year set on November of Fed, but bearish interest in technology stocks is still predominant, and the stock market darlings such as Apple, Meta, or Amazon right now becoming the ones that also joined the losing party. So as we can find short interest in Invesco QQQ, that is a very often product of pension funds and wealth funds, right now is hovering 6.2% of shares outstanding, a level last seen in 2012, and that's why we have kind of a room for anxiety. But after downperformed years, there's more likely that we'll have a rebound rather than lowering the troughs and even heading further to the south direction. That's why even if this more than a tenth of the stocks in the 100-member benchmark hit 52-week lows, as it was recently, I don't really bother about this, as I would bet on probability, and probability is boiling down to the fact that it's more profitable, more lucrative for investors to bet on market growth in the medium to long-term horizon rather than in reverse. So that's kind of a optimistic point of view right now. Selling baguettes, that's the one of the headline that's been attached to this Bloomberg's chart, and we can find there is a less and less people willing to go out there and stick their necks out to try and buy on those pullbacks. While stocks headed to the Christmas break with a modest weekly decline, anyone hoping for the rebound from October lows to continue in December bounce has eventually been banned. So that's a very, very poor December's performance, but that's very typical for outstanding years where we have a very low performance throughout the whole year. That's very, very low likely that the December will be somewhat miracle month for the market. Usually the momentum drags through every month of a year, and that's why this last month might be somewhat weaker in its sell pressure than previous, but still don't have this power of subsiding the previous performance and making everything in just 30 days. So that was market outlook for me, market movers will be somewhat, I would say, without fireworks, but let's look into it. Mm, if I just haven't shown you the window of previous market outlook, you may see the bar chart right now. That's selling Bagets sailing, and what I told was this December of 2022. All right, so heading once again to market movers. So what we got out there? Economic calendar. Economic calendar shows us. Let's me find out what was this week. Um, Unemployment rate out of the Japan. It's not of a large interest, but for this week, as I told, we don't have many of breaking through um, events on our way. But I will have my eyes turned to pending home sales for US, as we know, a leading indicator, as well with initial jobless claims that alongside with uh, alongside with many um, leading indicator index is the one that may I would say influence the um, inflation ratings to a large extent. So initial jobless claims on Thursday, pending home sales on Wednesday. Today there are somewhat important events, but without kinda significance that may impact the markets um, significantly. Okie dokie. So let's jump to another element that is a trade idea. So what we have out there. So one of the very interesting element recently was copper chart. So on copper, we can find that recently we have formed a ascending triangle. Ascending triangle is the chart, or rather the pattern that giving us around 60% of breaking to the upside when it's a bull market and around 53% when it's a bear market. Right now, we have a decisive point. Without breaking through this edge, this horizontal line at 3.9, I wouldn't bet on copper right now. For me, a copper may break down to the downside with forming somewhat that may resemble this trajectory. After heading back to the levels being noted on 28th of November, I would expect copper to slide even forward to around 3.3, and it's around 14 up to 15% of a profit. For me, however, copper must right now close this gap on the 3.8 and 3.85, and after completion of filling this gap, I would find out whether the copper have an ability of going upwards or rather downwards with break through this ascending triangle with a downward pressure. So on my radar, there is a copper that is more likely, as its bear market is more likely to go in a south direction, but you need to be very cautious. For me, copper right now is tending to go through, filling the gap, and right from here, if no market strength will be visible, I would expect that we won't go anywhere from there where overhead supply might be tough to tackle. In that scenario, I would expect copper to fill the gap, and afterwards, when this gap will get filled, if we will have a choppy price action around this recent lower band of ascending triangle, I would expect this one to slide even lower with a trading board set around the element like here, with risk reward ratio right then at 8.9, and in a longer time horizon with extension of a possible drawdown to the levels at 3.3 around, but that's the one of a trade that may take even up over 1 month. That's the one for the swingers, for the swing trades, taken in a longer time span of around 30 to 60 days with current volatility on the market. So copper is definitely the one of a subject of a study, especially with today's evening shooting star already been forming. We still have yet a couple of hours by the end of the candle close. So I wouldn't right now take any investment approach to copper, but right after market close, I would redefine whether it's in a fine a point to short. So if you wanna be informed what's my point of view on that current issue, subscribe to the channel. And I would say that's it in today's episode. Thank you very much for watching, and we'll see each other tomorrow at 9:15 a.m. If you enjoyed, just drop this like button, and let me know whether you have posed any questions on the chat as it's live. So if you haven't noticed yet, we are going through a live chat, so you may pose me a question on the topic that you want to have an answer to. So thank you once again, and we are seeing each other, and